In this video, we're going to take a look at incremental cash flows, project cash flows, as well as putting together a set of pro forma financial statements and using them to estimate project cash flows and a project's net present value and internal rate of return. Incremental cash flows for a project consist of any and all changes in a firm's future cash flows that are a direct consequence of taking the project. So if we take the project and cash flows change, they're considered an incremental cash flow. Some costs are not considered an incremental cash flow. We will consider opportunity costs, which are considered an incremental cash flow. We'll consider side effects, which are an incremental cash flow. We'll consider net working capital, which again is considered an incremental cash flow. We'll consider depreciation tax shields, which are an incremental cash flow. And we will consider a project's salvage value, which is also considered an incremental cash flow. So all of these, with the exception of sunk costs, are considered incremental cash flows. What do we mean by sunk costs? Sunk costs are cash flows that have already paid or promised to be paid. In other words, they've incurred in the past, and we will not include them in our current project's cash flow. For example, let's say a project is going to use a piece of vacant land that a firm owns that it purchased several years ago for $500,000. That $500,000 that we paid for the land is considered a sunk cost and should not be included in the project analysis. However, the cost of the land may represent what we can refer to as an opportunity cost. Opportunity costs are cash flows that are lost or foregone by taking one course of action rather than another. And it applies to any asset or resource that has value if sold rather than used. So, for example, if we could sell the land for $400,000, that $400,000 that we could sell the land for represents an opportunity cost. If we use the land in the project, we can't sell the land, we won't receive the $400,000. So we'll want to include that $400,000 as an opportunity cost in evaluating the project. Not the $500,000 that we paid for the land, that's a sunk cost, but we do want to include the opportunity cost. We also want to consider what we refer to as side effects. Oftentimes, for firms that have multiple project lines, if we undertake one particular project or offer a new product, it might affect the existing sales of our current products. It could help or it could hurt. For example, every time Kellogg's brings out a new breakfast cereal, it probably causes a reduction in its existing product sales of another breakfast cereal. We refer to this existing reduction in existing sales as erosion, and we want to be sure we include that. The point is, of course, we want to be aware of effects of positive and negative side effects when we evaluate a project's incremental cash flows. Next, we want to consider what we refer to as a depreciation tax shield. When we take depreciation expense on a project, the depreciation expense doesn't involve a cash outflow. It's a non-cash expense. It does, however, reduce our taxable income and therefore will reduce our tax expense. We say that the asset or depreciation expense provides a depreciation tax shield, and that tax shield is equal to our depreciation expense multiplied by the marginal tax rate. For example, a firm with $100,000 in annual depreciation expense and a 30% marginal tax rate has a $30,000 per year depreciation tax shield. That depreciation expense of $100,000 a year will reduce our taxable income by $100,000 and save us $30,000 in taxes. The next incremental cash flow that we want to consider is net working capital. New projects often require incremental investments in cash, inventories, receivables, and these need to be included in the cash flows for the project if they aren't offset by a change in accounts payable. For instance, if we design a project to sell a new product, we're going to have to build up inventory. Now, some of that inventory we might be able to pay for using accounts payable or credit, but probably not all of it. Also, when we make those initial sales, Some of them will be on account, and we won't receive cash directly. Our accounts receivable will go up. Of course, later on, as the project winds down, we'll sell off all of our inventory and we'll collect all of those receivables, and we can redeploy that capital elsewhere. We will typically assume that our net working capital investments are required, or there's a cash outflow at time zero and an equal cash inflow at the end of the project. Of course, those assumptions could be modified. We could have changes in working capital throughout the project, and we might not recover it all at the end. But our typical assumption, unless we're told otherwise, will be that we'll have an outflow of working capital at the beginning of the project, and we will recover that working capital at the end of the project. Finally, we might want to consider the salvage value of any equipment that we use at the end of the project's life. Because at the end of the project life, a firm is typically going to dispose of its equipment or fixed assets that it used in the project. Any expected selling price is referred to as the equipment's salvage value. And if we expect to have cash coming in through the sale of our equipment at the end of the project, we want to include that as a cash inflow at the end of the project's life. But we do want to be aware of the fact that any disposal might result in a taxable gain or a loss. Any gain will result, of course, in a tax liability, while if we have a taxable loss, if we sell the equipment at less than its net book value, we will have tax savings. Let's take a look at an example. Let's assume at the end of a project, the Cooper Corporation sells equipment that has a net book value, that's cost minus any accumulated depreciation, of $10,000, and we sell that equipment for $25,000. If Cooper has a marginal tax rate of 20%, it will have to pay a tax on that gain. Let's go ahead and calculate the gain and the tax payment. Our selling price was $25,000. We deduct our assets' net book value, which in this case we were told was $10,000, resulting in a $15,000 gain. If we have a 20% tax rate, $15,000 times 20% will result in a $3,000 tax liability. The $25,000 selling price will be a cash inflow at the end of the project, and the $3,000 tax liability a tax outflow. Let's summarize by taking a look at some typical cash outflows as well as inflows. We'll have outflows consisting, of course, of our initial investment. We'll have an outflow at time zero of any working capital. Again, that's investments in inventories and receivables. Over the life of the project, we might have outflows related to the repair and maintenance of equipment, or we might have other incremental operating cash outflows. Typical inflows typically include any incremental revenues generated by the project, any reductions of cost generated by the project, as well as at the end of the project's life, if we can sell the project or the equipment for cash, we will have salvage value coming in. And of course, at the end of the project, we assume we have a release of our working capital. Let's go ahead and put together a set of pro forma financial statements. In our example, we're going to assume the firm sells 10,000 units at $5 a unit. Our variable cost will be $3 per unit. We'll have fixed cost of $4,000 per year. We're estimating a salvage value of $4,000 at the end of the project. Estimated 5-year life. We've got a project cost of $30,000. And our depreciation for tax purposes will be $6,000 a year. That's $30,000 spread over 5 years, straight line basis. And we've got an additional working capital investment at time zero of $5,000. And of course, we'll assume we get that back at the end. We're going to assume a 20% required rate of return for calculating our net present value and a 30% marginal tax rate. All right, we're told our project cost $30,000, and that, of course, is a cash outflow at time zero. We were told we had a $5,000 working capital investment. Now let's go ahead and build up our pro forma income statement. We're told that we were going to sell 10,000 units at $5 per unit, so that's $50,000 per year. Our variable cost, we're told, is $3 per unit. At 10,000 units, that's $30,000 a year, giving us an annual gross profit of $20,000. We were told our fixed costs were $4,000 per year. Our depreciation expense will be $6,000 a year. Again, this is tax depreciation. In this case, we're going to assume we've elected the straight line basis. And we take that estimated cost, or our cost of $30,000 spread over our estimated life of 5 years, and we get $6,000 a year. Notice that when we calculate our tax depreciation expense, we ignore any estimated salvage value. That gives us earnings before taxes of $10,000. We take our gross profit of $20,000, subtract our $4,000 fixed cost, and our $6,000 depreciation expense. Our taxes then, at a 30% tax rate, will be $3,000 per year, leaving us with net income of $7,000. And that simply is our earnings before taxes of $10,000 minus our $3,000 tax expense. Our project's operating cash flow will then be $13,000 per year. And our operating cash flow will simply be our net income, and we're going to add back our depreciation expense. So we have our net income of $7,000, add back $6,000 in depreciation expense, and we've got $13,000 for our projected operating cash flow for our project. Again, we will assume that that $5,000 initial investment in working capital at time 0 is released or recovered at the end of our project. So we have $5,000 coming in at year 5. We were told that we expected to be able to sell our project, or rather our equipment, for $4,000. That was our estimated salvage value. Of course, if our equipment has been fully depreciated, which it is, it cost us $30,000. We took $30,000 in depreciation expense, so our net book value is 0, which means we have a $4,000 gain on the disposal of our fixed assets. And a 30% tax bracket means we're going to pay an additional $1,200 in taxes related to that gain. Now that we've identified all of our cash flows, again, we have our annual operating cash flows, we have our initial working capital investment along with the release of the working capital into the project. We have the equipment cost at the beginning, its $4,000 estimated salvage value, and then the $1,200 taxes that we're going to pay on that gain. We're going to sum all of these cash flows each year, and we end up with our estimated project cash flows of $35,000 going out at time 1, $13,000 a year annuity cash flow over years 1 through 5, plus our salvage and our tax on the salvage at the end of the project. Now we can calculate our project's net present value, which we recall is the present value of our cash flows minus our project's cost. The present value of the $35,000 going out at time 0, of course, is $35,000. We can then go ahead and calculate the present value of our $13,000. Take our $13,000 divided by 1 plus the interest rate, which in this case was 20%, so 1.2, to the first power, because we're discounting it back 1 period. The present value of that $13,000 discounted back at 20% for 1 year is $10,833. The $13,000 in year 2 discounted back at 20% is $9,028. The $13,000 in year 3 discounted back 3 years is $7,523. The year 4 cash flows are discounted back to $6,269, and the year 5 cash flow is discounted back at $8,359. Our net present value then is simply the present value of our cash flows less the cost. We can simply sum that up, equals sum, add together all of our cash flows, and we get a present value of $7,113, We could also use Excel's net present value function. We have to be careful here because the net present value function is sort of poorly named. It's really a present value function. So we're going to go equals NPV, and our rate was 20%, and our cash flows, notice the value at time 1 is 10,000. We're going to go all the way out to year 5. That is the present value of our cash flows, discounted back at 20%. And of course, to get the net present value, we have to subtract the cost. So if we back off the cost, we get our, oops, I mistakenly took the present value of our present values. I needed to change that. I need to take the present values of those cash flows. So the present value of the cash flows is 42,013, and of course then when we back off the cost, we get our net present value of 7,013. To calculate the IRR in Excel, it's very simple, equals IRR, and we can simply highlight our expected cash flows. And we have an IRR of 28.5%, which makes sense because that means our present value or net present value was greater than 0. And of course, we would accept this project.